Hello, I'm Shelly. Today I want to share a topic regarding to the 4 tax-saving blind spots that a business owner might always miss, which can lead to the unnecessary tax payment during the current year. This video going to dive deep into common pitfalls like misunderstood the laws, because a lot of SME business owner, right, they thought when their business making loss, then they no need to pay tax, which this is totally incorrect. And some director also mismanaging their salary, and a lot of director like to put their personal expenses as a business expenses into the account, which lead to the heavy tax add back. Some business owner also might overlooking the valuable tax incentive such as capital allowance, green investment tax allowance, and etc. So don't let these hidden traps drain your hard-earned money. Try to empower your business strategy with insight today.
Many SME owners assume that once they hire an accountant, everything is taken care of. But every year, they end up paying unnecessary taxes. The truth is, tax savings aren't about evading tax. They're about smart, legal planning. However, most SMEs overlook 4 key blind spots, potentially losing thousands or even tens of thousands of ringgit each year. Blind spot 1. Assuming losses mean no tax worries. Just because your income statement shows a loss doesn't mean LHDN will ignore you. In fact, loss-making companies can still be audited, especially when errors or irregularities appear in your accounts. Case example: a retail company didn't write off obsolete inventory and damaged equipment, but still put in the expenses claim into account, which made their losses appear higher. LHDN disallowed deductions, leading to a tax bill plus penalties. Tips: do a year-end tax review with your advisor. Make sure all impairments, bad debts, and depreciation are properly recorded. Blind spot 2. Poor use of director's salary versus dividend. In Malaysia, many SME owners wear multiple hats: founder, director, and sometimes even the main employee. It's common for directors to draw income from the company they run, but how that income is taken as salary, dividend, or both, which can make a huge difference in terms of tax efficiency. Malaysia's tax system treats salary and dividends very differently. If you only rely on one method, say drawing a high salary, you may be subjected to progressive personal income tax rates as high as 30%. On the flip side, if you only pay yourself dividends, you may miss out on EPF contributions, personal reliefs, and even affect your loan eligibility. Case example: a director earning Rm 20,000
per month restructured to 8,000 salary plus 100,000
year-end dividends. This reduced personal tax by over Rm 15,000
tax.
Tips: stay in lower tax brackets with a moderate salary. Use dividends to supplement income. Always document dividend declarations properly. Blind spot 3. Mixing personal spending with company expenses. In the hustle of running a business, it's not uncommon for SME owners in Malaysia to swipe the company credit card for both business and personal use, sometimes out of convenience, sometimes unintentionally. But here's the problem: when you mix personal spending with company expenses, you're not just confusing your books, but you're inviting risk from the tax authorities. While it may feel like your company's money is your money, the law says otherwise, especially for SDN-BAD companies, which are separate legal entities. That means the Inland Revenue Board, LHDN, treats personal expenses claimed as company expenses as a red flag for tax evasion. Case example: a director used company funds for personal travel, disguised as site visits. LHDN rejected Rm 40,000 when claims and triggered future audits. Tips: open a director's loan account for personal use. Keep clear receipts and justifications for all business expenses. Use separate credit cards and bank accounts for business. Blind spot 4. Missing out on tax incentives and deductions. Many SMEs wrongly assume tax incentives are for large corporations only, but Malaysia provides numerous reliefs to support small businesses, many of which go unused. Case example: a small food manufacturing company in Penang invested Rm 200,000 in automation machinery, but didn't know about the Automation Capital Allowance, ACA, a special incentive offering 100% capital allowance and an extra 20% for qualifying expenditure. After a tax consultant reviewed their case, the company refiled its tax return, saving over Rm 40,000 in corporate tax. Tips. Here are some common and powerful incentives and deductions available to SMEs in Malaysia. 1. Automation Capital Allowance, ACA. For companies investing in automated production lines, especially in manufacturing and selected services sectors. 2. Green Investment Tax Allowance, GITA. Incentives for companies investing in energy-efficient technology, solar panels, or sustainable systems. 3. HRDF Training Deductions. If your company contributes to HRDF, you may claim double deductions on employee training programs under approved schemes. 4. Renovation and Refurbishment Tax Deduction. You can claim up to Rm 300,000 on business renovation or refurbishment, extended until 2025, subject to conditions. 5. Capital allowances on equipment, from laptops to delivery vans. If it's used for business, you may be able to write off the value over time. Conclusion. Tax savings don't come from loopholes. They come from awareness and planning. For SMEs, understanding these 4 blind spots means protecting your profits and lowering your risks.
Okay, these are the topics that I want to share today. I hope you have a better understanding how to do more tax saving. Thank you for watching.